Let's analyze this one together, guys. So price is 1.898. Do you see our tax amount? Now, this tax amount is not accurate because this tax amount is likely what it was being taxed prior to it being complete. Okay, the taxes are going to be higher. This was 2023's taxes. Doesn't mean that will be 2024's taxes because now there's 8 units on there versus an empty lot or whatever might have been there before this was actually built. Okay. So we got to be a little cautious with that number. What else are we going to get here? So 8 separate living quarters. Now it doesn't tell us what it does say great opportunity for investment and rental income, Airbnb, etc., etc. It does meet CMHC MLI Select energy requirements. So that's a plus for MLI Select. So we could get multifamily financing on this particular property. So that's going to help. Let's now analyze this, and we're going to put this into the analyzer and see what it looks like. Here we go, guys. So first off, I always like to put in the real picture, okay, so we know what we're analyzing here. There's not much to go off of here. We're talking about a 1,300 square foot 2-story upper unit, and then we're talking about a basement unit as well. I believe that's what it says here. Let me just look. So, and there's also a single detached garage for each unit. Okay. There's rooftop access as well. So there's lots of cool little things in this particular place. I'm going to just assume you could get 2,000 for the upper and 1,000 for the lower. I could be off on that. Let's throw that in. So it's 3,000 times 4 units, 3 bedrooms up. In this particular one, 1-bedroom suites. Okay, so it's 4 bedrooms per unit, 3 up, 1 down. That's what I'm assuming. Of course, these things we would have to clarify. 22 upper, 1,200 basement without utilities. Perfect, Sam. Thank you for that. So let's use those numbers. That's 3,400 per unit. 3,400 times 4. We're going to go equals 3,400 times 4 this particular unit. We're getting 13,600 in rent. Let's change the purchase price here, guys. This one is 1.898. 1,898, 800 is what the asking price was. Let's leave it at 20% down unless you guys want me to change that. I'm going to change this to 6%, 30-year amortization. Unless you guys want me to change that, let me know. That gives us a $9,100 a month mortgage payment. The taxes on this, it's saying 3,000, but I don't think that that is accurate. I would say you're going to be approximately 1,800 per unit. You might be more or less than that. Let's go 1,500 per unit times 4. You're 6,000 a year, which is $500 a month. Okay, just to make this easy for this example. It might be more than that. Insurance, let's go with $100 per unit, so $400 a month. There's no strata fees because you own the entire building in this case. So here we go with a 5% repairs and maintenance, which might be high on a brand new unit that comes with full home warranty as well. We could lower that and say, okay, we're only going to use 3%. And these units rent very, very fast. And the vacancy rate in this particular neighborhood is less than 2%. However, let's just be conservative and use a 4% vacancy rate. And now we start to see the kind of cash flow we're going to get as $1,280. Now, what kind of legal costs? You're going to have more legal costs on something like this. Let's up that to $3,500. Maybe we still have the travel costs. We don't have any immediate repairs, but maybe we want to put some money buying blinds or those sorts of things. Let's leave $5,000. We may or may not need an appraisal. We don't need an inspection. And we probably want to hire reserve fund on something like this. Okay, so it's $13,000 in rent. We might want to put aside 20 grand for a property like this as a reserve fund. So now what do we need for cash to close on this? Significantly higher. We need roughly 400,000 to be able to close on a property like this using the numbers we're using here. And what are our ROIs going to be like? Well, here we go. Do you notice, guys? Very, very interesting. Our average yearly ROI is very, very similar to what it was with the property we just analyzed. So what's the difference between these two? Well, the difference between these two is this one is new, which means our repairs and maintenance might be less, which means we are now having the building help us qualify for the financing versus us personally qualifying for the financing, because we might be using MLI Select in this case. So there's lots of pluses that might go with something like this. However, the negative is we have to come up with another significantly more down payment, right? Is an environmental assessment required? Good question. Likely in this case, because we are not the builder is likely be taking care of that assessment. It may, I'm not sure if it's required or not. And Sam says CMHC MLI financing can do 5% with 50-year amortization, 5% with 50-year amortization, and down payment about less than 10%. So let's just change these numbers, guys, and see how this changes if we use MLI Select in this case. 10% down, we're using 5%, and we're changing the amortization to 50. What does our cash flow change here, guys? Do you notice the difference that it makes in our returns? We've jumped from 174% up to 327, and our amount required to close is significantly less, and our cash flow on a monthly basis has gone up significantly. Now, why is that the case? Putting less money in, but our cash flow is increased. Well, that's because we're now amortizing it over a 50-year period. What a difference that makes. Yes, there's going to be CMHC fees. Absolutely. There's going to be some other costs that are involved with this that we might end up tacking onto this, or tacked onto our mortgage, et cetera, et cetera. But again, guys, the purpose of this is to give a quick analyzation and say, property 1, we analyzed. Property 2, we're analyzing. Property 3, we're analyzing. And now once we've analyzed more than one property, more than a few properties, it gives us an idea as to what's actually available and what we can actually get as far as cash flow, as far as returns, et cetera, et cetera.